Good afternoon, this is Serge with Northstar. I want to show my investors an opportunity that exists. Currently, some of the major banks, for example, Societe Generale, are offering bonds at attractive, well, in and of themselves are not attractive. It's what you can do with them that makes them attractive. So SocGen has this bond that will pay a yearly rate of 15%, but that breaks down to a quarterly rate of 15 divided by 4, 3.75%. So let's use $20,000 in our example. That'll be $750 in 3 months. The this is a strange kind of bond. It's based on the values of Facebook, Amazon, Netflix, and Google. As long as these four stocks, all four of them, are trading at a price higher than 65% of their value on the 28th of September, which is called the settlement date, as long as they're trading higher than 65% of that value, or they haven't dropped by 35%, the Societe Generale is obliged to pay quarterly interest based on a yearly rate of 15%. In other words, 3.75%. If all four of them are trading at a higher price than the settlement date, it must be all four, not just one of the four, two of the four, three of the four. If all four of them are trading higher, not only do you get your interest, but you also are bought out at par. That's 100 cents on the dollar. And we're able to buy this at a slight discount of 2.25%. So that is additional money that will be earned. In other words, we will buy this bond at 19,550 and it will be bought back from us at 20,000 when it matures, or when Societe Generale is forced to buy it back because all four of these stocks are trading higher. Now, this offer has a catch, and the catch is if any of the four stocks are trading lower than 65% of the settlement date value on that date, basically Societe Generale will not pay the interest and does not have to, just simply maintains the bond. They can choose at their discretion, at the discretion of the bank, Societe Generale, they can choose to deliver the physical stock of these four companies to the investor in lieu of the bond. So, for example, if Amazon were to drop 50% and these other three did not drop in value, let's assume they're still at 100%, and SocGen, Societe Generale, decided to deliver the stock to the investor, basically the investor, remember we're assuming a 50% drop, the investor would now own shares of Facebook, Netflix, and Google worth exactly what he paid for them, actually worth a little bit higher than what he paid for them since he bought them at a discount, and he would have a 50% reduced value on 1/4 of his investment. So if we assume a 50% drop, he will have lost approximately $2,500 of the 5,000 that was committed towards Amazon. The idea that we have is to hedge this downside risk. This is very unlikely. A 35% drop in such a short period of time is highly unlikely, but it's not impossible. I would say the probability is less than 1%, but nevertheless, if it were to occur, it might be painful. So my suggestion, my recommendation, is to buy options to protect against that. This shows you the cost, the total cost of buying an option on each of these stocks, proportionate. I'm not going to go into the finer details of the options, but basically these options have one thing in common. You can't lose more than the cost of the options, or $854 total. So if all four stocks move higher, you'll have wasted the money you put in here. They will expire worthless. If, however, the worst case scenario for the bond happens and we get a drop of, say, let's stick with our example, let's say two of the stocks drop by 50% and the other one, just for the sake of argument, don't change. That's unlikely to. It's more likely that they'll all move in tandem. So let's say we have a drop of all four stocks of 40%. 40% of $20,000 is $8,000, so we'd be left with $12,000 if we were to cash out immediately, and a loss of $8,000. These options would have, in that case, if you look here, they would have a value of approximately $15,000. You would be able to sell the option for $15,000. You'd still be able to sell your shares, as we said, for $12,000, so you would end up with $27,000, which is more than, well, which is a $7,000 return in just 3 months, or about a 30% return in just 3 months. That's extraordinary. So we'd almost be wishing for a meltdown of the markets in this scenario. In the more likely scenario of a let's go over the scenario of all the stocks rising to higher levels. That's pretty simple. We're going to make a total, we said, of 450 plus 375 times 20,000. Sorry, it was 750. 750. Oh, we had calculated $1,200. We're going to make $1,200. We'll have spent $854. We'll be out of the trade. All we'll have made at the end is 1.7%, but remember we made that in just 3 months, which is a 6.9% yearly return, which beats most bonds and CDs. Finally, there's the intermediate range, and that's where we should focus a little bit more. So let me zoom in on that. I'll hide this a little bit so we can see. If the market were to drop by, say, 20%, we would likely see an increase in volatility between 10 to 15%. Excuse me. Let's put a 15% increase in volatility. So our overall options positions would be worth, we said a 20% drop, somewhere around $4,000 to $5,000. Remember, in that situation, you are getting paid your dividends, so you're getting paid $750. This $854 that you spend, you get it back. This represents the savings after this is returned. So if you see 4,000 here, it means you got $4,854 back. So basically, you'd still have your dividends, and you'd have $4,000 to $5,000 back. That would be a handsome return of 23% in the quarter. You would still be in the bond. You would need to protect yourself for subsequent quarterly drops, but you're starting off at a real nice price point. You have plenty of money with which to buy an option. You could buy even with the amount of money from this, you'd probably have enough to fund an entire 1-year option 10% away. Option prices will have gone up, so it will cost you more to get in, but not so much more that this is not attractive. So that's if all 4 of them go down. That would be the ideal situation, and it's actually a likely situation. They may not all go down the same amount, but they tend to move in tandem. If just say 2 out of the 4 move down and 2 out of the 4 do not, they stay the same. Let's just emulate that. Well, here's that emulation. Let me refresh here. And you see on a 20 on that kind of drop of just 2 of the stocks, I've taken 2 out of the play. It would cost you still the 850, not the 550, but this is to be the value, and it's somewhere around. You can see here somewhere around 20%, somewhere around a value of 2,500. We'd be spending so somewhere around $2,200 would be your profit on the overall position, and you would still get dividend income. So again, a nice result. So even if just 2 of the 4 stocks move down, it's nice. Now let's assume a scenario in which one of the stocks moves down a lot, say Amazon, and the other stock don't move down enough. They do move down maybe 10%. We're going to first emulate that separately. Our Amazon stock, at a 50% drop in the market, the volatility of Amazon would go through the roof, I can tell you that. It would probably increase by as much as 80%. So that Amazon alone position at a 50% drop would be worth around $7,000. We'd have to would still have cost us $854, so we wouldn't make $7,500. We'd make about $500 less. That's $7,000. Your Amazon has only lost, it's lost 50%. Presumably, your other stocks will also have lost some value. Let's assume the other stocks just lost 10%. So I'll show you that. So the other 3 stocks, 10% drop, their volatility might be down by 15% or so, or up by 15% or so. They would be worth somewhere in the range of $1,500. So that 15 is in addition to the Amazon 7,000. So you'd realize about a $9,000 profit on your options. You would still be in the stock unless in the bond, unless Societe Generale decided to put all the stocks to you and get out of the position. That's at their discretion. If they were to do that and you closed all the positions, you would take a 10% hit by our assumption on 3/4 of your investment. That's roughly $2,000. And you would take a 50% hit on 1/4 of your position. That's another $2,500 for a total of about $4,500 hit. That's if you closed out all the positions. And then you would still have your gains, of course, on the options, which would represent a net gain of around $4,000 when all things were closed out. So basically, in these interim scenarios, as you can see, this can be quite attractive. The areas where it's probably not going to do anything for you is on very small moves. Let's try a 5% drop in all four stocks. You would still get your, let's put all four positions on so we see our costs. You would have you wouldn't have a big drop in volatility. Maybe volatility increased 10%. You would have the passage of time, which we've taken into account. Okay, so as you see here, on a 5% drop, your options have no value. Whatever you spent, you could recover some amount. You would have lost, maybe if you closed out all positions there, it would have cost you, you'd recoup $354 of the $500. You would still get your, so it would have cost you $550. You would still be getting your dividend, so you would make 0.0375 of 20,000. You'd make 750 in dividends. It would have cost you, as I said, about 500. You'd only make net about 250, which is a very, it's about 1.25% in 3 months, or 5% annualized. Still not a bad outcome. So basically, in most scenarios that one can envision, you're going to make 4 to 5% return. That's if the stocks are higher or say in a minus 10% range. If they drop below there, you're likely to make quite a bit more money. That's it. Here are the, I've already showed you this. I can send you the term paper of this bond offering if you're interested. Contact me. Thank you very much for your attention, and I hope this was useful to you.